It's a very exciting time for stablecoins. First, we're going to finally see some regulation and legislation about stablecoins. And also, we're seeing more Wall Street firms come into the space, or at least ready to enter the space. I'm sure we're going to get a lot of stuff to talk about today. To start with, could you each introduce yourself and tell us what kind of role your company serves in the stablecoin ecosystem?
Sure, happy to. I'm Nikos Andrikogiannopoulos. I'm the founder and CEO of Metrika. We offer risk management and compliance solutions to financial institutions getting into the space of digital assets. We cover a variety of digital asset risks, and we enable financial institutions to do custody, to issue assets, by streamlining the risk process and understanding the risks that they're undertaking. So, pleasure to be here.
Hi everybody, my name is Timm. I'm one of the co-founders and managing director at Particula. Particula is a specialized risk rating provider for digital assets. We are mainly focusing on so-called asset-backed tokens, which means all kind of tokenized financial asset, real-world assets, but also payment tokens like stablecoins. And yeah, we have a holistic real-time approach. So we are looking on the token not only from a credit perspective, but we are assessing it based on the economic design, legal and compliance, as well as the technical implementation and security to reduce the information asymmetry that are currently still present within the industry on the investor side and provide investors with real-time insights.
I'm Nick Van Eck. I'm one of the co-founders of Agora. We are a fiat stablecoin issuer and infrastructure provider.
And I'm Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. We provide the benchmarks that facilitate price discovery and liquidity in markets, whether it's a rating or an index. We launched our first product in the rating side in the space about 15 months ago, the Stablecoin Stability Assessment, which is a product that gauges the risk of a stablecoin depegging from its intended one-to-one mark against a fiat currency or a basket of fiat currencies.
It's a tokenization conference, but Nikos, why are we talking about stablecoins?
I think this is the first probably digital asset that has a large and strong product market fit. It is a necessity in the crypto world so that you don't have the volatility of owning a cryptocurrency. And I think this is an exciting year because as the product with the strongest product market fit, it's getting regulated. And I think everybody's anticipating that over the summer, there's going to be the Stable Bill, the Genius Act bill, getting passed, and that a lot of financial institutions will walk into the space and look at creating their own stablecoins. And I think everybody's excited at that prospect, and I think it's a fundamental tool that we need in the crypto world.
Nick, why are stablecoins so important in your view?
Yeah, I think if you look at the fundamental value of blockchain technology, it's the ability to move value 24/7 instantly around the world and in a composable fashion. So it's just all about moving money, right? And so naturally, moving the US dollar, especially cross-border, is one of the biggest beneficiaries of that technology. And so I think what we've seen historically is stablecoins be used primarily as a means for moving assets from one centralized crypto exchange to another. But we're also starting to see the rise of non-speculative use cases and traditional PSPs using stablecoins to facilitate faster cross-border money movement. And I think we'll see continued growth there over the next 20 years.
As you guys mentioned, stablecoins are not only getting bigger in the crypto space, but also making waves in the traditional finance space. Actually, Tether, the largest stablecoin issuer, is also one of the largest buyers of the US Treasuries. Chuck, what's the implication of that?
Yeah, so I think that's going to be particularly interesting, especially when you look at the context of the last week, where you had such market volatility and a spike in Treasury rates. And so there's a lot of questions of, like what caused that spike in Treasury rates. So at the end of the day, right, all markets are based on supply and demand. So when you have a stablecoin market that's going from the hundreds of billions to perhaps the trillions, you're going to have an inherent buyer, a natural buyer of US Treasuries. And that comes at a particularly interesting point, I think, in markets, that you can have this kind of emergence of a new set of buyers in stablecoins in US Treasuries. But that, in turn, introduces a whole host of new systemic risks around financial stability that stablecoins can play. And so that's a role in the kind of global macro perspective that stablecoins have not been in before. So I think there's still a lot of policy questions and clarity that are going to be coming out in the next, call it quarters or years, of how to think about stablecoins, not just from their efficacy and use cases in the marketplace, but also from the role they play in systemic financial stability.
For sure. That also brings us to the industry's efforts to make stablecoins more secure and more safe. Timm, tell us, what are the challenges of attesting to the stablecoin reserves?
I guess there are several challenges, and maybe we can break it down. So on the one hand side, from my perspective, there are still key providers missing in the field. So for instance, auditing companies. They simply do not feel comfortable on the one hand side to take the liability to attest those reserves. And on the other hand side, at least generally speaking, there might be some professionalized providers, but it's also a lack of knowledge. Yeah? And when we're currently looking at the implementation within the industry is currently running on monthly attestations via PDF that are issued by the issuer. Yeah? So we do not have the verification tools in place, and this is exactly the problem what we are currently facing when it comes to scaling. Because when we look at the target state, of course, we can make the statement we would like to, and we need to testify those reserves in real time when we have markets that are open 24/7 and we can trade 24/7. Yeah, but despite the lack of specialized providers that are moving into the space, taking the liability, and also have the necessary knowledge to perform such attestations, I guess also the fragmented infrastructure when it comes to data quality, data availability, plays a huge part. Because when we look at more complex structurings of stable coins that are not backed one-to-one by US dollars, but by a basket of diverse assets, we need to create the situation that we have API connections to a diverse set of brokers, custodians, and also other providers where we can testify the reserves in real time. And I guess this is the main challenge. And what we're currently seeing in the market when it comes to attestation practices like proof of reserve or also smart data feeds, it's also centralization risk, because for smart data, also the issuer is providing the data, so bringing it on chain is not increasing the transparency at all. And in regard to proof of reserves, like I mentioned, we do not have the necessary toolbox and the players in the market to really accelerate this and funnel this kind of knowledge into the adoption.
And I think one of the things that Timm called out is it's actually because the industry is moving and growing and evolving at such a rapid pace. It's really hard for even traditional audit firms to wrap their heads around things like Ethereum. But when you have new blockchains launching every single day, right, for them to keep up and really be able to put their name behind saying, oh, there was $1.21 billion outstanding on these 12 chains today, it's challenging, right? The other thing is that many of these banks, particularly the better the bank, like the larger and older the bank, the worse their tech stack is. And so it's hard to pull things in an automated fashion. And so what you end up having sometimes is a patchwork of APIs because you have cash at different banks or treasuries at different brokers, and then also like Excel files from like the daily fund admin report. And so you're stitching together a lot of pieces of data that aren't easy to do, and a lot of traditional providers cannot do yet.
Yeah, and I guess in addition to that, this is also one of the main lags for auditors to moving in. We have no standards. So what are they auditing against? When we look at the traditional financial world, of course, we have certain procedures already in place that we can utilize as a benchmark, but this is simply not the case. On the one hand side, due to the fact that the industry is evolving so quickly, like you mentioned, Nick, but on the other hand side, because there is no consensus about standards that we are using. So when we look at the digital asset space, it's the same situation like in the traditional financial industry, where we have very separated standards across different geographies, across different blockchain ecosystems, today many people talked about the risks and also the challenges about interoperability, which would be also a necessity for auditors to assess the reserves on every blockchain or related to tokens deployed on different blockchains. So I guess this is also a big part which needs to be overcome.
I would also add to that I think that you can have a policy structure and a regulatory structure that sets the baseline, but having those additional benchmarks of risk assessments or indices or kind of how setting the standards of the industry can sit alongside and enhance the understanding of risk and pricing of risk beyond what the regulatory structures are. And so the benchmarks that we produce play that role in traditional markets, and I think it's going to be even more valuable to play that sort of role in digital asset and crypto markets.
How could regulators help with this? It seems like the Genius Act doesn't really address this problem, does it? Nikos, do you have anything to add?
I think the fundamental issue and why the Genius Act does not address this issue is that a lot of the stablecoins that are being created are meant for distribution in the crypto world. And in the crypto world, a lot of that risk falls on the individuals. So even though, as Chuck mentioned, we need benchmarks on those stablecoins, most of those benchmarks today or their risk assessment of the stablecoins would not look good from an institutional perspective. But it is important to start understanding where we are, right? Because if you're launching on every single blockchain that exists today, by trying to increase your distribution and kind of get critical mass as a stablecoin, which is an important factor in your success, then you keep aggregating operational risk from those protocols. And I think a lot of credit rating agencies will argue that the weakest link is the one that will determine the reputational risk that you have on the asset, on the stablecoin itself. So back to your question, I don't think the regulatory framework will address that, just because the market need that is driving the growth of the stablecoins right now creates a risky profile for them. And we see that by Tether, for example, right? Tether does not kind of meet the regulatory standards, and it is created by design not to meet, because that's the use case. They want to be kind of used in that part of the world. So I think what we're going to see is that we're going to see more stable coins that are conforming to regulation, that are thinking prudently about where they deploy, what kind of operational risk they're taking, which custodians are willing to take custody of those assets, acknowledging the risk that they have, and tokenized asset issuers, how they choose their protocols in that way. So I think there needs to be a balance between the opportunity and the risk that you're taking.
I think we also have to all agree on a definition for what a stablecoin is, right? Because I think people refer to a lot of different things as stablecoins, right? Something that is vanilla, where it's just tokenized, where it's just short-dated treasuries, like in cash in a bank, versus CDP structures, versus I was in the Uber on the way over here, and a new project announced a funding round where what they're doing is basically taking OTC trades and then hedging it and calling themselves like a stablecoin, right? As like some sort of like strategy. That to me is absolutely not a stablecoin, and I think it's totally a misnomer. So I think first what we need to do is agree on, okay, what is a stablecoin, and then what are all these other things that look like different types of fixed income instruments, or frankly like hedge funds, and then we can sort of go from there. Because we still really haven't laid the groundwork for some of the definitions of these things, and I think that is going to bite us at some point when you have one of these things that calls itself a stablecoin completely unravel.
And sorry, just to add, I think your point, Nick, is very valid. Once we understand the taxonomy, then we know what kind of exists in each bucket, right?
I guess that also brings us to the question of how do we rate stablecoins? Chuck, what kind of metrics or framework do you use at S&P Global to rate stablecoins?
So the product that I mentioned earlier, the Stablecoin Stability Assessment, that's actually a non-rating product. So what that means is it's not regulated, it's free, or generally free, and it is not a measure of underlying credit risk, but instead a measure of depegging risk. And so in this particular case, you start with an asset quality assessment and looking at the underlying collateral and the quality of that collateral, et cetera. And then we look at 5 additional factors that include regulatory issues, execution risk, structure risk, and those can bring the score down. So that's a very specific methodology in providing the score for a stablecoin stability assessment. For a rating, the rating, which is a regulated product, and measures the default probability or the probability of an investor getting their money back, those would follow, depending on the structure of the stablecoin, an already established methodology. So it could be something like a money market fund. It could be more like an asset-backed structure. So depending on the structure of the stablecoin, we would take a methodology that already exists and adapt it to what the stablecoin that we're looking at, and apply a rating. To date, there isn't a public stablecoin that has a public rating. But we feel confident that's going to change and could change as soon as this year even.
We are also seeing more Wall Street firms launching their own stablecoins. JPMorgan has a JPM coin, though they don't call it stablecoin. And Fidelity is testing its own stablecoin. We're also hearing from Bank of America they're going to ready to enter the space once the regulation clears up. Timm, do you think they're necessarily more reliable? Do you think they're going to replace Tether and maybe USDC and take over the space as the largest players?
I do not know, but maybe to give this kind of general understanding and maybe also contributing to the points Chuck just made, because they have a huge influence on this question. What many people are not aware of is that tokenization is simply changing all major product features. So independently from the underlying asset, whether we are talking about a former analog asset, digital asset, single asset, or basket, when you tokenize it or add additional smart contract, you're changing those product features. And you have new valuation mechanisms, you have new regulatory framework, you bring those tokens differently into the balance sheet, into the tax declaration compared to the underlying. And of course, what Chuck just outlined, you have certain factors like the technology implementation, security, that are contributing to the overall risk profile. And what we are currently seeing is that the same underlying asset, like US dollars or treasuries whatsoever, is tokenized from different providers out of different jurisdictions with different tax stack and ownership rights. And the main challenge in that regard is, on the one hand side, we have geofencing for certain products. So you were talking about USDT. I cannot get exposure anymore in the European Union, at least on a regulated way. And on the other hand side, at least I expect that regulation will lead to a certain centralization, which we can already see. I do not know if everybody heard of it, but just yesterday, especially in Germany, the German regulator, so the BaFin, the SEC equivalent, just forced Ethena to wind down their business because they had concerns about organization, compliance, and investor protection, which is already leading to a certain concentration and also market opportunities for more established players. And on the other hand side, we are seeing that so far at least only 15 stablecoins were approved under MiCA, which is also concentration. So I can imagine, especially for intercompany transfers, the issuance of stablecoins from big providers makes a lot of sense. If they can create interoperability in any kind of way, I do not know. Then we're getting back also to the KYC AML topic that other panelists discussed earlier today. But I can imagine a certain concentration for stablecoins that can free flowly without KYC AML, stablecoins that are generating yield, stablecoins by established players for intercompany transfers, and then more niche products which are fulfilling a certain certain tasks, so to say. For instance, in trade finance, when we're seeing, okay, we're issuing a stable coin and maybe a payment via milestone. We have not talked about the gaming industry, where niche stable coins can also play a big role. So overall, I think it's definitely reasonable to consider that big market entrance will lead to a reset in the market share distribution.
Nikos, what do you think the stablecoin market is going to look like in 20 years?
Well, just want to add a little bit to the previous question before I go there, is that I don't think that all stablecoins will be equal, and I think financial institutions have the ability to create stablecoins that are based on different fundamentals than kind of the startups or scale-ups like Circle or Tether. A few months ago, we were talking to a very large financial institution, and they have a very big use case about remittances and kind of payments abroad. And they said, we cannot use any of the stable coins out there in the market because they don't have a rating. And even if they had a rating, that would be much lesser than the rating of our financial institution. So we are forced to create our own stablecoin that meets the requirements of a financial institution. So I think that goes to answer your question before, but also the next one, which is, I think financial institutions have the ability to build a regulated product that meets the requirements for institutional adoption. And I think the future will look like more regulated products that can have a mass appeal on the traditional finance side. I think we're a long way from there, but I think we're close to that changing, to turning the corner on that side.
Nick, what do you think of that? Do you think every bank will need to have their own stablecoin? What's your vision for the stablecoin market in 20 years?
I don't think every bank will need to have their own stablecoin, but they might, right? Or like a tokenized bank deposit, right? Because what they're really trying to solve for is improving collateral mobility and moving funds between different jurisdictions. I don't anticipate that they will compete with the Tethers or Circles of the world. They're serving two completely different purposes, right? Like JPM has had JPM coin for years, and no one outside of that ecosystem uses it. And so, it may ultimately have $5 billion in value outstanding, but that just may be capital within JPMorgan, right? So it's not necessarily accruing net new capital to that business. Then you have providers like Circle or Agora, where we're actually trying to go build this global liquidity network that serves developers, trading firms, payment companies, and has a much broader swath of utility. And really, I think will ultimately serve companies and even some who can launch their own, but they can't launch their own, right? But that value collateral mobility and the utility that comes from that. And then I think we can go into a long tail of sort of the decentralized stablecoins, but I think ultimately this will be a multi-winner market with multiple different user profiles, and I think will look many ways very similar to asset management, where you have a number of exceptionally large players, but a long tail of 100, 200 managers that are also quite large, right? But serve different niches, whether that's private credit or building index funds, whatever it is.
I might add to that I mean, we think the tokenization of everything is going to happen. So if you look at 20 years out, the entire functioning of the markets will likely be on blockchain. And so that's every iteration of market execution, transaction risk management, investment portfolio construction will all be conducted on blockchain. So the role for the mix of kind of currency or stable value products, I think could be exponential to where we are today. And so one of the things you've heard mentioned up here is you have a whole spectrum of you've got CBDCs on the one hand, you've got stable coins, yield-bearing stable coins. Like there's a multiplicity of products that can fulfill different functions in a financial ecosystem, but the role of stable coins as kind of a conduit for transactions, whether it's a bond issuance or whether it's money transmission, I think is already well established. And now with the prospect of legislation in the United States this year around stablecoins, I think we're really on the launch pad of unlocking the use cases that stablecoins can play in this emerging blockchain-driven and oriented financial marketplace.
And Francis, if there is one prediction to make in the next 20 years, in my view is that CBDCs are not going to happen in the way we predict, just because fintech innovation has always been done mostly by private companies that are more agile and can move faster. I was in a discussion around the digital euro, and I was very surprised when the governor of a large bank, who is part of the committee there, was saying from the moment we press the button, it will take 7 years to launch the digital euro. When you hear about those timelines, that cannot be a timeline of financial innovation when you see stablecoins moving at the speed of light and kind of multiple iterations of them kind of and evolving.
It does sound like CBDC may take longer to come, but for stablecoins, most of the major ones right now are denominated in US dollars. I guess I'm just curious, if the stablecoin market continues to grow, what does that mean for the US dollar status? Especially recently during the tariff saga, we've had some debates, potential concerns around de-dollarization. Nick, what do you think?
I actually think that stablecoins are going to grow US hegemony. I think the reason why there's very few non-US dollar stablecoins is because no one wants them, right? Many people outside of the United States want to hold dollars and have access to dollars, whether you're in Argentina, Africa, Southeast Asia, or developed economies like Western Europe or Eastern Asia. So I actually don't think that we're going to see stablecoins grow the proliferation of non-US currencies. I actually think what's going to happen is over the next 20 years, US dollar stablecoins will nuke like most non-G10, G20 currencies, because everyone in countries that have either low rule of law or very little to no financial infrastructure are just going to adopt blockchain-based finance as their financial infrastructure. Today, with a mobile phone and an internet connection, you can now become your own bank, right? And that is extremely powerful and a huge upgrade to global society. And so I think that's actually what you're going to see happen is increasing US dollar proliferation, sort of tariffs aside.
Tim, do you have anything to add to that? What do you think the stablecoin space or just combining with CBDC are gonna look like?
I guess I would totally support what Nick just outlined, also Chuck's perspective. We can already see it in practice. So when we look at the Euro stablecoin from Circle, I guess it's compared minimum 60 million, more or less, something like this. So the interest in at least Euro-backed stablecoins is not really there. We have also not that much competitors. I guess there are several projects, 1, 2, 3 out of Germany who are trying to create this kind of situation. But I guess from a strategic perspective, it also makes a lot of sense for the US to go all in because besides US-backed dollar stablecoins, we were also talking a lot about yield-bearing stablecoins and the possibility that stablecoin providers could become the largest buyers of US treasuries, which makes a lot of sense also from a macroeconomic perspective for the US to move into that direction.
Yeah, that's pretty interesting. We briefly touched on the new products in the stablecoin space. Do you guys think there's any need for yield-bearing stablecoins? What's the advantage and what may be the disadvantage? Chuck, what do you think?
So repeat the question again?
The yield-bearing stablecoins. Do you think there's a need for that?
Well, I think there's already been shown to be a need and a demand for it. So I think you're going to see continued emergence of yield-bearing stablecoins in the marketplace.
Yeah, and I guess we have to define what are yield-bearing stablecoins. Are they like yield products, right? They just are dollar, denominated, right? And yeah, absolutely.
But I think there is a need, whether we call it yield-bearing stablecoin or money market fund. There is a need for something where you can have, an application on your phone. You can spend with your Visa, MasterCard, and still you can get some yield out of that account, which is much higher than the checking accounts that you have at the bank and are much more friendlier in terms of the user experience. So I could think that, my kids, as they grow up, I would think they would experience a world of personal finance that would be completely different. And whether it's a yield-bearing stablecoin, it will be a dollar that will be accruing interest and which you would be able to spend, while at the same time not thinking like in terms of a checking or a savings account or an investment in a money market fund.
I guess it's also a little bit depending. So, of course, there's a certain need for yield-bearing stablecoin, but it's also mainly dependent on the product implementation and the structuring. So many structures we are currently seeing in the market, of course, have their flaws. They are either designed offshore or instead of absolute ownership of the underlying asset, we only have a claim against a counterparty we can hardly evaluate because we have limited access to financial data, a lack of track records, so on and so forth. So it also comes down to our overall topic, what do we need to create the necessary trust in the market and also benchmark? Because when you look at ratings, it's mainly about we have information asymmetries in the market. Investors cannot perform their due diligence on every instrument available, and the rating agencies are decreasing this kind of information asymmetry and give them the necessary trust to funnel liquidity in order to accelerate market adoption. And I guess when we look at the structuring, so the issuer, the token, and the underlying, we need that several parties, also the big rating agencies, are stepping in, and that we are creating benchmarks for the token level we can benchmark against. So when I look at the product structuring, where I have a startup issuing a claim against their own balance sheet and it's yield bearing, I guess we do not need this kind of product structure. But what we need are highly compliant, well-structured products where we have absolute ownership of the underlying asset, where you have the possibility to access instant liquidity, to switch from your payment vehicle, like your stablecoin, into a yield product, making it also easy to perform optimized treasury management and give investors the necessary trust that they can also enforce their rights associated with the token.
I want to add one more thing. I think Timm did an excellent job describing the risks on stablecoin. And I don't know how much the audience, I think, realizes that those stablecoins that depend on smart contracts, when those are issued by startups or scale-ups, the control is still exercised. The asset control framework on that stablecoin is still exercised by the entity that's the issuer. So there is still some risk. There is not, if the startup goes away, how will the asset be controlled and by whom? Does the government step in? Is it like FDIC in terms of the banks? What happens in those scenarios? And I know there are bankruptcy remote vehicles to protect you from the bankruptcy of the entity, but what happens with actual control of those assets? So I think there are open questions out there of how we address those things once they're regulated.
Yeah. If Genius Act got enacted and got passed, what kind of immediate changes are we going to be expecting, Chuck?
I'm sorry, what immediate
if the
changes?
Genius Act got enacted, what kind of immediate changes could we see? And how could that reshape the crypto market, the stablecoin market?
So the immediate changes, I'm sorry, in the structure or the...
If the Genius
Act.
Oh,
okay, sorry. I'm having a hard time hearing you. Yeah, so I think that the immediate impact of the legislation in the U.S. will be, first of all, to set a standard in the United States and kind of put into motion a legislative backdrop to regulatory formation to frame an ecosystem, a stablecoin ecosystem in the United States. So I think that in and of itself will be highly valuable to the development of the stablecoin use cases. But beyond that, I think getting the world's largest economy and world's largest capital market fully engaged and providing clarity on structures will have a galvanizing effect around the world. So I think that can help lay the foundation for better cohesion across regulatory jurisdictions to come together on a more uniform approach towards stablecoin frameworks, which will ultimately further power and unlock the potential of stablecoin use cases.
Timm, what do you think if the Genius Act gets passed? What do you expect to happen in the market?
I guess, of course, we will see market adoption accelerating and also an increase. I guess we're currently at 230 billion stablecoin plus minus. Yeah. So my guess for this year, maybe early next year, would be targeting 500.
Yeah, I guess I have the same question for the rest of you guys. Where do you see the market, stablecoin market cap to be in 1 year? Nikos?
I think definitely an increase in the market cap is the measure, the quantifiable measure. But I think to Chuck's point, I think it's absolutely right that the US plays an outsized role in terms of the finance ecosystem. So the fact that stablecoins will be allowed and that financial institutions will start moving into that space will definitely have an amplifying effect on how regulators around the world move. So I think even if we're tracking regulatory action and other financial institutions across the world, we will see a lot of them engaging in figuring out how they participate in that economy. And I think that's probably an even better indicator than the market cap, which eventually will grow. But we need to see that kind of, peak of the funnel activity from financial institutions all over the world.
Nick, where do you think the stablecoin market is going to be in 1 year?
In a year, 350 billion. In 5 years, 2 trillion.
What about you?
Yeah, well, I'm probably not going to say a figure, but I would say I did see that Standard Chartered came out and predicted $2 trillion stablecoin market by 2030, I think, or 2029 even. But I would expect with policy clarity coming out of the United States, that it'll be multiples bigger in the course of the next 2 or 3 years, and maybe 1 multiple or 1.5 multiple in the next year. So it's really just, I think, contingent upon how quickly the legislation gets passed, and then how quickly the follow-on and regulatory formation is beyond that. So to get, that's going to be, I think, the key catalyst or hinging factors on how big the stablecoin market can grow in the next kind of 12 to 18 months.
It seems we're running out of time. Thank you so much for joining the panel today, and thank you so much for sharing your insights.